which is why I think it's really important for investors not to wait for a pullback. And I'm not saying that as a gold executive. I think it's very misleading to wait for a pullback when you don't know a pullback from what price. Because when we met in South Africa in February, but with gold's at 2,800. And if we're talking about 38% or a 30% retrenchment, and you wanted to wait for gold to go on sale, well, now gold at 4,200, if you went on a 30% retrenchment now, it'd still be higher than what it was when we were there in South Africa. If you're going to hold gold for 10 or 15 or 20 years, I don't think it will matter in the long run whether you bought it 4,200 or 2,800. Of course, I would have rather bought it 300 or 1,600. I'm not trying to be flippant about that.
There'll be a turning in the gold-silver ratio, and at a key level is 65, and we're at that level right now. We're seeing the gold-silver ratio drop. It was as high in COVID at 126. I would even say to some gold guys, if you're 50-50 gold-silver, for example, or maybe have some small amounts of platinum, you can roll some of that gold ounces now into silver ounces to further maximize what I personally assess will be a single-digit run on the gold-silver ratio.
Francis Hunt and Matthew Piepenburg, both longtime macro and precious metals analysts, frame this discussion around a simple but often misunderstood idea. Waiting endlessly for a perfect pullback can be far more costly than most investors realize. The core argument is the time horizon. When gold was trading near $2,800, many investors expected a 30 to 40% retracement before committing. Today, with gold much higher, even a sharp correction would still leave prices well above those earlier levels. For investors thinking in decades rather than months, the exact entry point matters far less than exposure to a long-term monetary trend. As the gold-silver ratio compresses from extreme levels seen during crises, reallocating some gold into silver may offer greater upside. If that ratio continues to normalize toward historically lower ranges, silver could significantly outperform. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I mean, since I've been in the markets, it's really since November of 2024, but I mean, the comics is never, my whole career, the comics was a net exporter. Now it's a net importer, but as soon as they get the gold in the comics, it's leaving the comics. And for decades, less than 1% of comics gold stood for delivery. This summer, I saw 100% standing for delivery. In other words, 20,000 K standing for delivery. The LBMA's free float last December was zero. It was T plus 60 days. In other words, there's no gold in that market. Why? It's not just a comics wonky anomaly in the comics. What it is a signal. It's an absolute signal that the world, sovereign wealth funds, sovereign nations, and bigger players outside of the speculators and the shadow bankers and the hedge funds, they want their physical gold. Again, because they're already preparing. They're loading their bullets before the army crosses the river. They're loading their ammunition before the dollar tanks. They're getting their gold now. And the comics is just one extreme example of that. And the LBMA silver market, again, started there in 1987. It's the world's primary market for daily price discovery. It's a private market. It's got contracts governed by British common law. But, it's got a supply problem. In October this year, the LBMA market in London literally seized up. It had 700 million ounces in its vault, of which 650 million ounces were for ETFs. So there was no free-floating available silver. There was another 140 million ounces were not even offered for liquidity. And I don't say this to just throw out numbers, but they needed another 50 million ounces injected. And they blame that on worker or truck shortages or the weight of silver. It was harder to transport. Again, it's a T+1 exchange. It was T+8 weeks. And today, standing contracts, promissory notes for silver are at a rate of 700 million an ounce. There's only 50 million ounces for actual delivery. So in other words, what I'm saying is the LBMA is tapped out. It's a first in, first out, cash and carry exchange. In my entire career, when I was trading commodities and trading bonds before I figured out precious metals, the lease rate in the cash markets for silver was 2%. Now it's above 5%. So the entire free float of global silver is 36.8 billion. That's a very, very tight supply. So my question is, which billion bank will be the first to do the run? It's like that Kevin Spacey movie during the 2008 crisis, which was the first hedge fund to dump their MBS and go long CDS and ruin their reputation, but save their butts. It's going to be the same with what party's going to make the run on the LBMA or the COMEX markets, because they're literally out of the precious metals. And what that signals to me, without getting into all the math and all the wonky futures contracts, and what just happened in the silver market this December on the 12th, they tried to raise the margin cost to short the silver price, and it didn't work. What we're seeing in the dysfunction at the COMEX and the LBMA is a world that has already seen the uselessness of that dirty shirt, best shirt, worst shirt, laundry. It's almost irrelevant because it's just a bad shirt, period. Fiat money is a bad set of shirts. The US dollar on a relative basis, we can debate. It's a rotten shirt too. But the point is, it's a fiat money crisis. The world reserve currency, the weaponized, distrusted, unloved, disgusting world reserve currency, post-2022 in particular, just isn't going to be the safe haven, neither will be the 10-year or the 20-year, or the 30-year, or the 2-year. Because I think the world's already catching on, and we're seeing that in the COMEX and the LBA, these nuanced little exchanges in London and New York that no one's supposed to follow or understand. It's just starting to make headlines on platforms like this. But what that's saying to me is these smarter, not necessarily better, more moral players, but the smarter players, the nuanced players, are taking their metals off because that is going to be the strategic asset in the next moment. It's not going to be the dollar. And I think, again, that's what we'll see in the next crisis. But using 2008 as a comparison, because of all the things that have changed since 2008, I think is a false comparison. Could be wrong. But what we've seen in the COMEX, what we've seen in the outflows, what we've seen in the LBA, I've never seen in my career, including 2008. So it's a it's not this time is different. It's actually, nothing's changed since throughout history, from 250 AD to 1990s Yugoslavia to Weimar. It's just a bad paper system. It's dying. Gold and silver aren't pet rocks anymore. They're strategic stores of value. They're strategic reserve assets. And I think that's going to be the test. Where will the world go? The informed world go? The retail world? I'm not sure. Where will they go when things go wrong? I think we're already seeing that everyone sees that these markets are tapped out. They're over-levered, and they're supported by fiat money that has no faith and confidence or trust, which is extremely hard, as John Rubino says, to quantify or qualify or measure. That trust is dying at every level. And so again, from those things I see in the comics, even with the petrodollar, look, we've been trying to get Maduro out. The U.S. is not freedom, loving, and democracy. We're trying to do regime change. We're trying to do sanctions. And now you're going down, we see Besant going to China, begging for China to buy U.S. treasuries. And we're seeing waivers for Exxon to drill oil out of Venezuela, because we've been bullying Venezuela for years, but now we need some of that heavy crude because our refineries can't use the Texas oil that's light crude. So in other words, from the petrodollar to the COMEX to central banks to the BIS, all the signals to me post-2008 make it a very different world in the next crisis. Whether it's in 2026 or tomorrow is really irrelevant to me. It's so inevitably on the horizon that whenever that crisis comes, I don't think it's going to be the same world. I think the signals we're seeing from even the BIS, from even the LBMA and the COMEX markets, which most people aren't supposed to follow, are very dark on the dollar. And again, it's and I also think the stagflation that you think we're mistiming is already here. And I think we could talk about the U.S. versus Europe, or the recession and the non-recession. I think the U.S. has been deep in a recession for 3 years. We lie about the recession just as much as we lied about temporary inflation. We lied about the independent Fed. We lied about the recession. And as you know, I think that was Charles Goodhart. When you politicize data, it's almost always a lie. And as, what was it, Jean-Paul Juncker, the president of the European Commission, what do we do when the data is bad? We lie. I think the trust in the data, like the trust in just about everything else that comes out of it, the Brussels or DC think tanks, is not there anymore, because their data, and this maybe sounds sensational, to me is fiction. And it's just, you know, you lie to keep time buying. You lie to buy time. You lie to do the tricks from the Caymans to Brussels to the Fed to the Eccles building. But I think we feel that lie in Stevensville, Michigan, or Toledo, Ohio, or Cleveland, or Speyer, Germany. We don't feel that in Monaco or Palm Beach or LA. And it just depends on who you ask and what data you believe. But I think we're in stagflation. I think the world's moving away from the dollar. And I think we're going to see an inflationary reaction to the stagflation that we're already in. I do believe that deflation and inflation run in cycles. And we can certainly have deflationary moments like a market mean reversion or a recession or even an unofficial recession. But I think we're already in one. And to your point, when the NBR EER tells us we're in a recession, it's like it's like a doctor telling you're sick when you're already in the morgue. It's way too late. Which is why I think it's really important for investors not to wait for a pullback. And I'm not saying that as a gold executive. I think it's very misleading to wait for a pullback when you don't know a pullback from what price. Because when we met in South Africa in February, but with gold's at 2,800, and if we're talking about 38% or a 30% retrenchment, and you wanted to wait for gold to go on sale, well, now gold at 4,200, if you went on a 30% retrenchment now, it'd still be higher than what it was when we were there in South Africa. So it's trying to pick that window to time, I think, is very dangerous. I think it's misleading to people that want to protect themselves from this openly dying, melting ice cube, which is fiat money in general, the US dollar in particular. I'm not saying that as a gold executive. If you're going to hold gold for 10 or 15 or 20 years, I don't think it will matter in the long run whether you bought it 4,200 or 2,800. Of course, I would have rather bought it 300 or 1,600. I'm not trying to be flippant about that. But you're comparing a precious metal to an ice cube. And in terms of its store of value, I just worry that some of these messages are going to get confusing to people. But if you're thinking 20 years out, 30 years out, and I do think gold's going to be at multiples of a higher price level. I think we all agree on that. But I think the timing of the stagflation is already past. I think we're in it, certainly in the US. I can say that from my personal experience and my personal bias of the distrust of the BLS and DC.
The dysfunction now visible across the precious metals markets is not a technical glitch or a temporary bottleneck. It is a signal. Physical gold and silver are being pulled out of the system by sovereigns, large institutions, and informed players as trust in fiat money continues to erode. Delivery stress at major exchanges, rising lease rates, and shrinking free float all point to the same conclusion. Paper promises are being questioned, and physical metal is being prioritized. It reflects a more profound shift driven by debt, politicized data, and a loss of confidence in currencies and bonds as safe havens. In that context, waiting for perfect timing becomes dangerous. Long-term protection matters more than short-term price levels, especially as stagflation quietly embeds itself into the system. Let's get into the interview.
I have the same views on the recession. But I've been arguing since 2022 that we've been in a recession. We just changed the definition of it mid-stride. We changed the goalposts. So certainly it's on my mind. We can get into the details on that. But in terms of the last 3 months, for me, I've been looking at the breakdowns in the repo markets, the COMEX, and even this QE language we'll get into in more detail. So I think the real story behind the last 3 months is the same story we've had in the last 3 years, the last 5 years, 6 years. It's just culminating. And it's boring, but it's really important. The bond market to me is everything. Credit and debt is everything. It's the rotten wind beneath the wings of our so-called capitalism and exceptionalism over the last years. It's the critical grease in our engines, and it's frankly drying up. That's the key for me. And we're seeing that from the repo markets to the Fed, from private credit markets and shadow banking to commercial banking, from Joe Sixpack to Jerome Powell. And without this grease, everything seizes up. So I think liquidity is going to come. We've got this non-QE Q in December. It's clearly going to be here structurally longer than just a few months, I think. There won't be time, in my opinion, for a last dance, Henrik. We'll talk about that. I don't think this is 2008. I think the jig is up, as we saw in 2020 and as we saw in April of this year in 2025. I think after 40 years, from 1980 to 2020, of an artificial bond bull market, we are entering a natural bear market in the bond markets, the sovereign bond markets. The yields will rise, and synthetic dollar destroying liquidity is going to come in waves. That's what I see for 2026. I just see the grease drying up, the liquidity drying up, and the cracks are everywhere. They started in the repo markets in 2019. We saw them in 2020, saw them in the banking crisis of 2023. We saw it in Liberation Day of 2025. We're running out of that rotten wind, or that grease, and we're going to need to find it somewhere, and that's going to come from a mouse clicker at a central bank near you. That's going to me, have a negative impact on the DXY coming into 2026. It's going to continue to be a tailwind for precious metals, which won't go up in a straight line. But I just see the culmination of all these things. I think the credit market is everything. It's boring, but it's not that hard. It's not that boring. Debt is everything, and debt was the story of our so-called success, and we're hitting a wall in debt, and I can't wait to get into the details on that.
Francis.
Yes. So your question was, what is the biggest thing that's moved on since we last spoke? And for me, it's all been about the fact that we're in a debt-based collapse, and that interest rates go significantly higher. We were the first to call the turn in the debt market, and a rates increase expectation in 2020 on the US markets. In 2021, we rolled our opinions when all the Japanese rates were in the sub 1. They were 0.79 on the 30-year. We said these are all going to break out to much major highs. Now everybody's a big spotter on the Japanese 30-year rates and the 40-year and the 20-year. And now you actually have the 10-year above 2% just tonight, which was part and parcel of driving the precious metals markets. So our position has always been rates higher, debt down, and this is the turbo juice for precious metals. So you've seen the yen gap up on rates on the Sunday session, and you've had an absolute surge in gold, silver, and platinum. I would add also that I don't think the stock market's the most interesting thing. Henrik referenced February. In fact, we are down in gold ounce terms. The core advice I gave then, and I continue to remind people today, is that in February, when we last spoke, is you've got to be precious metals aggressive, and that there'll be a turning in the gold silver ratio, and that a key level is 65, and we're at that level right now. I'll just remind people of that chart share on the stock market. I don't think the stock market is the most important thing. We are moved into an epoch where the biggest story is the preservation of capital, and the preservation of capital means you are aggressively long silver, platinum, and and gold ounces, as well as potentially miners if you can get your certificates. This chart is showing you two things. It's showing you the NASDAQ divided by gold ounces. You can see when we spoke this year in February, you were here, you were in the right shoulder essentially of a inverted head and shoulder in an adjustment downwards, I say, in gold ounces, which should be your new basis of accounts. My primary hypothesis is that you do not have a valid basis of account anymore in any fiat. The debasement in fiat and debt is in the Ernest Hemingway absolute escalation to the downside. The convexity is steep now. And as a result, any form of measure of wealth, earnings, or anything can only be meaningful on the big time frames in gold ounces. So your stock market is underperformed. Everything is underperformed. By the way, here's where Brent Johnson was telling us the silver guys are losing their head about crossing $25 again. That was a squeeze primer in a 30-year macro upside HVF, and that's what it's done since. So he literally called the moment, as we were calling the direct opposite, that silver was about to go into a melt up. And since then, we're seeing the gold silver ratio drop. It was as high in COVID at 126. I would even say to some gold guys, if you're 50-50 gold silver, for example, or maybe have some small amounts of platinum, you can roll some of that gold ounces now into silver ounces to further maximize what I personally assess will be a single-digit run on the gold-silver ratio. So it's still early days. If you look at the SPY divided by gold, if you look at miners, this is still really early days. We've been warning you all this was going to happen. We've said the primary emphasis is foundational money capital preservation, not the stock market, not anything else. Your wealth increases the most by being in miners, and by the way, the facts have now shown that for the year since January, you're at about 156% on GDX. You're over 100% with both silver and platinum, and gold is having another stellar year probably made 70%. I'd have to check that now with the recent price action, but likely to have done so by the end of the year in my personal view. So I'd leave that as my opening statement.
What all of this ultimately points to is a structural shift, not a temporary scare or a repeat of past crises. The credit system that powered decades of growth is losing momentum, and the liquidity that once masked deep imbalances is no longer flowing freely. When debt becomes the constraint rather than the catalyst, the rules change. Capital preservation moves to the forefront. In that environment, assets tied to absolute scarcity and monetary history naturally regain relevance. Precious metals may remain volatile, but their role is no longer speculative. It is strategic. This is about navigating a debt-heavy world where trust, purchasing power, and long-term stability matter more than short-term market noise. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.